growth and expect growth to be a bit different for us than it's been in the past. So as opposed to growth through acquisition, which I don't think will occur, we're going to be primarily, if not exclusively, focused on organic growth. And that organic growth is going to come in a few ways. One is that we're very focused in terms of our client and customer segmentation, and we just have to get more out of our existing client base. And if you look at the segmentation we've done in the company in terms of the way we go to work in countries or in our products, there are those areas around the world that we've labeled as invest to grow, and we've got a couple handfuls of those. We've got those where we view as staying the course, reasonable GDP style growth, and we've got those that we actually don't necessarily see the robust opportunity where we should be, in essence, trimming resources, supporting customers and clients, but not in the investment or growth mode. Because when you try and force growth in those places, we've learned that it typically, isn't good growth. So coming to work in 100 countries, people often say, how do you decide where you want to be and where are those places that you want to make investments? And the answer is in many ways quite easy and very straightforward, and that is it's where our customers and clients want to be. Where do the Nestle's, where do the Coca-Colas, where do the General Electrics see growth? And it's our objective, it's our desire, being on the ground, to have the resources. In order to be a bank and to be successful, digital has to be an integral part of that strategy, and you can't think of it along separate channels. And what we see today from the consumer parts of our business is that the way we're interacting, from the way we're attracting customers towards our products and towards the things we're doing, has changed. The ways that our customers are choosing to observe and to be part of their financial lives, where, as an example I use is, the serial balance checker who used to call our call center 5 times a day to hear their balance can simply go online, or we can actually give them, access to the mobile app where wherever they are, they can check those, and we can allow people to, in essence, craft or to be the architects of the information they'd like to receive and what time they'd like to receive it in. And we know that the way our younger customers want to interact with us in some cases is very different from, some of the older generations. We're piloting smart branches around the world where, we're building our new branches, in many cases 700 square feet, no counters, couple automated cash machines, lending machines, and I think that continues to evolve. And again, I fully expect over time that we're going to continue to see, as an industry, a reduction in terms of physical branch footprint. May not be or could be necessarily the number of branches, but if you look at branch traffic and the things today that we can do online or we can do in other ways, there's not that necessity to go into a branch like it was historically. One of the big challenges is that regulation has been evolving. And it would be like anything in life, it'd be great if somebody came in and said, here's the rules, go to work. What we've seen is the evolution of regulation, capital, increasing capital, liquidity, stress testing, resolution. And so all of those have been evolving. I think the good news is I think we're getting towards the latter stages of definition and implementation. So I'd hope in the next couple years we get those largely finalized. I probably spend somewhere in the magnitude of 25–30% of my time on regulation and on historic issues. I've been very conscious of making sure that even though the institution needs to spend a lot of time on regulation, that we take the people who need to spend time on it and that's where they spend their time, and our other people have the ability really to be focused on our customers and clients.